Hey everyone, and welcome to this explainer. I am firmly keeping my expert investment analyst hat on today because, well, we are about to run Rocket Lab, ticker symbol RKLB, through a seriously rigorous financial gauntlet. We're going to strip away all that flashy space-age hype and actually evaluate this company using the legendary investing frameworks of Warren Buffett, Benjamin Graham, and Peter Lynch. And after that, we'll put it through our own discounted cash flow and alternative valuation models to see what's really under the hood.
Okay, let's dive into this. We've got 6 structured tests on the agenda today to uncover the stock's true intrinsic value. First, a quick company snapshot, then the Buffett and Graham lenses, followed by the Peter Lynch lens, our DCF valuation, alternative models, and finally, we'll wrap it all up with a synthesis and final recommendation.
So, starting us off with Section 1, the Rocket Lab Company Snapshot.
Let's look at our baseline stats. We've got Rocket Lab trading at roughly $69.10, commanding a totally massive $36.8 billion market cap. But what's absolutely crucial for us to understand here is that we are looking at a company right in the middle of a major transition. They're evolving from a pre-profitability growth story into a scaled, vertically integrated defense infrastructure supplier. And they are heavily funded to make this leap. They're armed with $1.1 billion in cash and liquidity, meaning they actually have the immediate capital needed to keep the lights on and keep building out their vision.
This breakdown brilliantly illustrates that exact shift in their business model. Total revenue is projected to absolutely explode to $602 million in 2025. But notice how Space Systems now makes up roughly 2/3 of that total. They aren't just launching rockets anymore, folks. They are capturing the incredibly high-margin toll road economics of satellite manufacturing and components.
Moving right along to Section 2, the Buffett and Graham lenses. Let's see how the old-school legends handle this one.
Let's run Rocket Lab through Warren Buffett's strict checklist. On the positive side, they pass the economic moat test with flying colors. I mean, they essentially have a monopoly in hasty hypersonic testing, which is a highly specialized defense niche, and they are fully vertically integrated. They also easily pass on management. Founder Peter Beck's execution is just stellar. He consistently opts for operational fundamentals over cheap promotional hype. And debt? Highly manageable. They've only got $152 million in convertible notes against that billion-dollar cash pile. But here's where it completely falls apart for the Oracle of Omaha. Consistent earnings and high return on equity? Total failures. And Buffett's holy grail, owner earnings, the actual cash left over for owners after maintaining the business? Well, it completely fails his current buy criteria. We approximated here using their deeply negative $320 million free cash flow.
Now, what's really interesting about this slide is the overall trajectory. Yes, they remain profoundly unprofitable, logging a negative $198 million net income in 2025. But look at how the net loss intensity is shrinking rapidly relative to their explosive revenue growth. They are actively proving out their unit economics, even if they aren't generating those bottom-line profits just yet. So, what happens when we try to calculate Benjamin Graham's famous intrinsic value formula? You know, the one taking the square root of 22.5 times earnings per share times book value per share? Well, it breaks completely. Because Rocket Lab's EPS is negative, the formula yields an NA, or a mathematically impossible result. At this exact moment, a strict Graham value investor simply wouldn't touch this stock at any price. Literally no way. And if we run Graham's defensive investor checklist, we see the exact same story. Sure, they pass on adequate size and boast an incredibly defensive, strong financial condition with a current ratio over 4.0. That means their short-term assets massively outweigh their short-term liabilities. They definitely have the balance sheet to survive. But the total lack of earnings stability, combined with a completely non-existent dividend record, makes it a hard pass for Graham. Without current profitability, you simply cannot establish his required margin of safety.
All right, Section 3, the Peter Lynch lens. Let's see if a growth-minded legend is more forgiving.
So the crucial point is how Lynch would actually categorize this company. He would instantly label Rocket Lab a classic fast grower. His threshold for this category is usually 20 to 25% annual growth. Rocket Lab's total revenue grew an astonishing 38% year-over-year in 2025. This is fueled by rising launch cadences and a truly brilliant, aggressive M&A strategy where they're snapping up distressed space assets. Add in the low institutional ownership and strong insider buying activity at Rocket Lab, and it perfectly aligns with Lynch's preference for finding those undiscovered gems.
But we hit a snag. The challenge with Lynch's framework is his heavy reliance on the PEG ratio, price to earnings relative to growth. And again, negative earnings make a traditional PEG ratio impossible to calculate here. So we've got to make an alternative assumption.
If we evaluate their top-line sales growth against their staggering $1.85 billion backlog, it keeps the Lynch-style narrative of a dominant future growth engine incredibly strong. It looks rich for sure, but the backlog tells a very compelling story.
Time for Section 4, our discounted cash flow valuation. Let's get into the heavy quantitative data.
For this, our analysis uses a probability-weighted DCF methodology. We model a 15% chance for our bear scenario, which is driven by delays and heavy cash burn, yielding an $18.78 price. Our base case, at a 50% probability, values them at $64.10. And our bull case, factoring in massive constellation deployment wins and reusability success at a 35% probability, it yields over $131. To make this work, our model assumes a terminal growth rate of 3% and a stepping weighted average cost of capital, or WACC. If we run a sensitivity table on these metrics, we assume the WACC steps down from 12% today to just 6% over the projection period as the company de-risks massive milestones, the biggest one being the maiden flight of their new medium-lift Neutron rocket in Q4 2026.
When you blend all those probability-weighted scenarios together, the final DCF target fair value price comes out to exactly $80.78. Compared to current trading levels near $69, this quantitative model suggests a nearly 17% upside right now.
Let's look at Section 5, Alternative Valuation Models, to see how the broader market is pricing this. When we perform a comparable company analysis, looking at enterprise value to trailing 12-month revenue, the disparity is honestly wild. Traditional defense primes like Lockheed Martin trade at roughly 1.8 times revenue. SpaceX, based on private secondary market estimates, trades around 27 times. Rocket Lab, they are commanding a massive 69.2 times revenue premium. If we apply a second alternative model, like a reverse DCF, it actually implies the market is pricing in nearly 40% annualized revenue growth for the next decade just to break even on today's price.
Let's move to this quote and see how this builds a case for that premium. As noted in the research, these dynamics parallel the multiple compression observed in Texas Instruments during its CapEx-heavy investment phase. The market is rationalizing this massive premium today because Rocket Lab is right in the middle of a strategic infrastructure build-out. The expectation is that as these heavy investments finally bear fruit, like getting that Neutron certification, these elevated multiples will normalize. They'll compress down as revenue scales rapidly to catch up with the valuation.
Finally, Section 6, Synthesis and our final recommendation.
Let's summarize the core strengths and risks here. The strengths are absolutely formidable. A $1.85 billion backlog that is growing 73% year over year, and a highly defensive net cash balance sheet. Plus, Peter Beck's brilliant capital allocation. I mean, buying a $100 million Virgin Orbit facility for just $16 million, an 84% discount, that proves they know exactly how to stretch a dollar, which definitely mitigates some of those immediate cash burn fears. But the risks are very real. If the Neutron rocket is delayed beyond Q4 2026, or if SpaceX gets overly aggressive on pricing to squeeze them, that heavy, persistent cash burn will quickly become a major problem.
So, what's our final verdict? Well, value investors utilizing Buffett and Graham's frameworks demand actual profitability and a massive margin of safety. For them, at $69, this is a strict sell or avoid. It's just not their game. But if you look through the growth lens of Peter Lynch, the sheer momentum and revenue scaling make this a strong hold or even a speculative buy. Ultimately, our rigorous DCF valuation sees the asymmetric upside, pricing the fair value at over $80. And for us, that justifies a buy recommendation today for investors who are willing to stomach the execution risk. Which leaves us with this final, vital question as you consider your own portfolio. Does the sheer, unbounded potential of the space frontier justify paying this kind of extreme growth premium today? Balancing that immense technological innovation against strict traditional financial fundamentals is the ultimate puzzle of Rocket Lab. Think about it. Thanks so much for joining me on this explainer. Keep analyzing, stay curious, and I'll see you next time.